Continue with that story here on our business news. Losses on the markets are piling up as fears over the coronavirus continue. Last day of the trading week. France 24's Cole Stengler here to tell us more. Cole.
That's right. Well, world stocks headed for their worst week since 2008. Now, that's as investors try to make sense of the virus outbreak. Fears and uncertainty, though, mounting as new cases spring up worldwide. Wall Street, in particular, coming off one of its worst days in recent memory, with the benchmark S&P 500 tumbling 4.4% on Thursday, down more than a whopping 12% from a high this month. Now, the losses have pushed U.S. stocks into what's known as a correction. So markets fall more than 10% below their recent peak. It's not all that uncommon, with some investors even saying they remove undue excesses in prices. There have been 26 since World War II, averaging losses of around 14% over 4 months. The big question now is how long this one will last. Now, those looking for a rebound in European markets this morning will be disappointed. The FTSE showing some losses here, more than 2%, also some heavy losses on the CAC 40 here in Paris, down more than 3%, as well as some losses on the markets in Milan and the DAX over in Frankfurt nearing 4%. So some very heavy losses here in Europe. Markets in Asia earlier in the day continuing the losses to close out the week, and again some very heavy ones at that. The Nikkei diving down more than 3% there, as you can see. South Korea, Kospi also losing more than 3%. Hefty losses on the Hang Seng in Hong Kong and the Shanghai Composite as well. Those four indices now also joining Wall Street in correction territory. Now, what exactly is driving the global sell-off? Well, it's a mix of supply chain disruptions and damage to sectors like travel and manufacturing. That's playing a big role. But perhaps above all, it's about the difficulties in planning ahead. Jean-Emile Jamin reports.
Nervous glances up at the closing board as the bell brings the end to another frenetic day on Wall Street. Anxieties mounting with persisting uncertainty over the coronavirus outbreak.
Over last weekend, we heard that there were new cases in Italy, in South Korea, and Iran. This caused investors to rethink what was previously the consensus. Now the fear is this is broader, vaster than anticipated, and could have real spill-on effects throughout the global economy.
Fears from the virus have spurred a global sell-off, hitting major markets. Over the last 6 days, global share price declines have wiped out more than $3.6 trillion, while bond yields have been sent to record lows. On Thursday, the benchmark S&P index posted its worst day since 2011, while the Dow experienced its greatest one-day point drop in history. Driving the loss are disruptions to the travel sector and manufacturing, with global supply chains badly hit. In a recent survey, around a fifth of US companies said 2020 revenue from China could plummet by more than 50% if the epidemic extends through the end of August. But putting a time frame on the virus is mere guesswork.
A lot of investors, after they get out of the markets, they are still waiting for new news, whether they are not rushing to get back into the market. So I think the markets will be trending down until the virus shows some signs of under control.
With China's central bank already taking stimulus measures, other countries will be looking too for ways to reassure markets as fears of recession loom.
Now, investors in Japan also taking an announcement from the operator of the country's 2 Disney resorts. Tokyo Disneyland and Disney Sea will be closed for 2 weeks amid fears over the coronavirus. They're now slated to reopen on March 16th, but the closure could mean a hefty loss in revenue. Parks are some of the biggest tourist destinations around Tokyo, and last year they hauled in more than 30 million visitors. Now, finally, in Australia, the country's prime minister weighed into the growing economic troubles. Scott Morrison said he believes the virus could soon become a global pandemic. At the same time, he said any economic response from the government can't be too heavy-handed. Take a listen.
And initially, this has particularly been on those which are outward-facing, the tourism industry, the education sector, some of our marine exports, these sorts of things. And so what the advice from Treasury is not to do widespread cash splashes or anything like that. They're saying that's exactly what you shouldn't do. What they are saying, and what they're working on with the Treasurer, is to provide advice about more targeted, what they've described as modest, targeted and scalable measures, and that's what the government will be considering.
Of course, well, it's not just Australia. Investors around the world looking to see how governments are going to respond, and if so, what measures they'll be taking.
Indeed, a lot of remains to be seen over the coming months. Thank you very much, Cole. Cole Stengler with a look at the business news.